Welcome to the Wall Street exclusive daily show. So we talked about if you're an active investor and you want to make doubles and triples, look for sustainable competitive advantages. What if you're a passive investor? What if you don't have the time or the inclination? I'm going to give you the very best passive strategy that I think that there is. Before I do that, I want to remind you that Warren Buffett said what an advantage it is to not be a billionaire. So don't give up on trying to beat the market until you're a billionaire. Okay, here is the very best strategy if you have 5 years or more, in my opinion, the very best strategy for a passive investor, and that is buy the VO, the Vanguard Mid-Cap ETF Index Fund. Okay, first of all, why do you want to index? Well, if you're going to be a passive investor, indexing means no management fees. If you watched our segment on shorting, we said that it's good shorts are there. Shorts knock down the overvalued companies. If there's undervalued companies, longs build them up. So stocks are about right valued. So if you're not trying to beat that and say, I'm finding other values, you would just index. That way you pay no management fees for someone to pick the right fees for you, pick the right stocks for you. The stock market is historically bullish, so you can just let those companies compound for you. So the Center for Research and Security Prices keeps a mid-cap index. Vanguard just mirrors that index. There's no thought, and when a company is too large to be in that index, it takes it out. When it's too small, or when a company gets large and it should be added, it adds it. Okay, so its expense ratio is 0.09%. Compare that to like a hedge fund that'll charge you 2 and 20, 2% no matter what, 20% of the gains. Okay, so there's why to index. Why United States indexing? Well, the United States has a military that virtually has nothing left to accomplish. Continue to secure the United States' concerns forever, just about, as far as the eye can see, and there's no other country in the world that can even come close. Okay, so the U.S. is most secure militarily. It has an independent central bank that looks after the economy. So we print our own money, unlike Greece, and if we get in trouble, we can print more. Okay, so another reason is the U.S. has a very low population density. The future should be good for the U.S. because we have so much good land. Compare that to like Japan or Europe or anywhere. The United States has we can grow literally for just ever and ever without, that land will not be a problem for a long time. The United States also has the best geography with Asia on one side and Europe on the other. So, hey, we're right in the middle of the three big economies. That's great. The U.S. has the oldest constitution in the world and a remarkably stable government. Okay, hey, there's another good reason. Did you know that? The oldest constitution in the world. The U.S. dollar is the world's reserve currency and has advantages and stabilities built in relative to other currencies. Plus, if you live in the United States, all the better. There's no currency exchange risk. Okay, so the best risks are moderate ones. It is a small risk to not go broadly diversified all over the world, but the best risks are moderate ones. Being in mid-sized American companies spread out between 374 of them, like are in the VO, is not that much of a risk. It's a nice moderate risk to be only in the United States. Okay, so I see why indexing, I see why the United States, why Vanguard. Vanguard may be the most reputable finance company in the world. You have to put your money with somebody. Vanguard legitimately may be the most reputable company that there is. So, hey, there's a good reason. Okay, so I see why indexing, I see why the United States indexing, and I see why Vanguard. Why mid-cap? Well, large cap index funds are immensely popular, and so if you just talk to anybody on the street or you yourself, if you own stocks, there's a good chance you own a large cap fund. And so that's very popular with many retirees, just many people. Almost nobody owns a mid-cap fund, but everybody owns a large cap fund. Okay, so these large cap funds can accept a lot of money because the companies are huge and the funds are huge, and it's great for the finance companies. That's great. But the large cap popularity creates an opportunity for the mid-cap funds. So before we talk about that, let's just talk about something nice about the mid-cap in general. We said that when a company gets too large, it is no longer part of the mid-cap index and Vanguard will sell it. Hey, that's pretty nice. When you have a company that performs well for you for a while, you can take your money and run. That's nice. And then when there's it buys up the small companies on the one end and sells them once they grow. And that's a nice way to do things. If you compare that to the S&P 500, the SPY, as something becomes the largest component of the SPY, that actually becomes a larger part of the index. So instead of getting rid of it, it actually becomes your perhaps most overvalued stock becomes a larger part of it. Okay, it would be nicer perhaps to get rid of it like the mid-cap fund does. Okay, but now on rebalancing, so that's one nice thing about the mid-cap in general, is that when something gets too big, it gets sold. But now here's something very nice about the popularity of large cap funds. Large cap funds have gotten so popular and have so much funds that when a stock falls and has to be sold out of the large cap fund, there's many large cap funds that have to do that. And so that stock is probably going to get knocked down a little more than it deserves. But hey, that's just the stock that the mid-cap fund, the VO, is supposed to be buying. So because of the big popularity of the large cap funds, the mid-cap fund is going to be able to buy stuff up that it needs to add a little bit cheaper. And then also when the mid-cap goes to sell the companies that have grown too large, Chipotle right now is one of the largest companies in the VO mid-cap fund. Pretty soon that's going to be sold out and that'll be added to the large cap funds. And so the mid-cap fund will be selling that into something of a seller's market. It's not a one-for-one relationship, but I wrote an article about this last summer and I said, well, look at this. The VO has beaten the SPY, all the time since it started. And maybe that's just because it has smaller companies. Smaller companies tend to do better. But this seems real. This advantage of rebalancing seems real. I wrote that over the summer, and since then, if you look at today, VO beat the SPY today. If you look at the last 5 days, VO is beating the SPY. If you look at the last month from today, VO is beating the SPY. Look at the last 3 months, VO is beating the SPY. 6 months, if you go back to the summer last year, if you go back 1 year, if you go back to the inception of the fund, the VO is beating the SPY the whole way. Part of that may be because they're small stocks, but this rebalancing advantage seems real. Most hedge fund managers cannot beat the S&P 500. This VO is beating the S&P 500 like I thought it would, and I think it will continue to in the future. So if you have a long time horizon, indexing to the American stock market is a good idea. Specifically, the Vanguard Mid-Cap Index Fund, very low expenses, very reputable company, and has some very nice advantages to it.